Welcome to Chapter 3 of the Introduction to Financial Accounting, Demystifying Debits and Credits. In this chapter, we'll break down one of the most fundamental concepts in accounting. Debits and credits can seem confusing at first, but they are the building blocks of the double entry system that ensures every transaction is recorded accurately and completely. By the end of this chapter, you'll understand how they work, why they matter, and how they apply to every financial transaction, no matter the size or complexity. Let's dive in and unravel the mystery of debits and credits together. 500 years ago, a Franciscan friar and financial mind of the Medici family in Renaissance Italy, by the name of Luca Pacioli, recognized the duality of all economic transactions. If money was lent, we record the outflow of money and the corresponding creation of a note receivable. The purchase of goods represented an inflow of goods and a corresponding outflow of money. A sale of merchandise was a receipt of cash and an outflow of goods. Pacioli created the double entry system of accounts to properly record the duality of every economic transaction. In Latin, debitum meant what is due, and creditum meant something entrusted to another or a loan. Today, debit means left and credit means right. What we mean, son, is that the left side of a T account or ledger is the debit side. The credit side of the same atatsa is the right side. One is not good or bad, or more or less. There always are two sides to every transaction. Consider how much the world has changed in 500 years, and then consider the fact that Pacioli's double entry bookkeeping system has not changed. Accounting systems worldwide for any economic entity still use the double entry system of accounts. We are not advocates of memorization as a means of acquiring new knowledge, with one exception. Consider the word dealer. The letters in D-E-A-L-E-R represent an acronym for the entire universe of accounts for any business enterprise, from a one-person business to General Motors. D is dividends, E is expense, A is asset, L is liability, E is equity, R is revenue. If we commit this scheme to memory, we have captured the entire universe of accounts for any business. Whether it's Dorothy's lemonade stand or General Motors, these 6 accounts stated here are the only possibilities, except for valuation accounts, known as contra accounts, which we will discuss in time. Notice that assets are increased with a debit. We say assets have normal debit balances. Liabilities and capital are increased with a credit. We say they have normal credit balances. The debits for assets equal the credits for liabilities and capital. Expenses are increased with a debit. Revenue is increased with a credit. Dividends are increased with a debit. Assets, expenses, and dividends have normal debit balances. Liabilities, equity or capital, and revenue have normal credit balances. Here in this slide, we see 3 transactions recorded in journal entries, JE1, JE2, and JE3. JE1- records the owner's investment of $1,000 in the business. JE2 records the purchase of equipment for $200 paid with cash. JE3 is the payment of the phone bill for $10. Notice that debit-credit equality is maintained. Later in the program, in the accounting cycle, we go from journal entries to financial statements. Accordingly, if you are not clear on journal entries now, and we will clear it up in the chapter on the accounting cycle,